Okay, so before we ever look at the markets on any time frame, whether we want to trade a 4-hour, whether we want to trade a 1 hour, a 15-minute, the fact of the matter, it doesn't matter what time frame you want to trade. This, what I'm going to show you, applies to all time frames. So when we have a market and there's price action and we make a peak formation high or a peak formation low, as we know. So whether you call this piece at the top over here the peak formation high, and we label this as the peak formation low. Now, if you don't or haven't watched any of the previous YouTube videos that I have created, and you don't use the order flow following strategy, then it's also not a problem, but I would recommend you go and watch that. So basically what we are doing when we are trading, and this is what I'm going to show you, is trading inside of the range. So here we have a range. Here we have at the top the peak formation high over here, and here we have the peak formation low. So alternatively, we could call this the swing high and the swing low. So, or the source to source. We are trading source to source. So if we are selling from the source. If we are buying near or around or at the source. At the bottom, which is obviously the peak formation low or the peak formation high. Okay, so this is trading inside of the range, and this could be a 1 hour time frame, could be a 15-minute time frame, a daily time frame, 4-hour time frame. It does not matter. All that matters is that we know that this is the range, the source to the source, or the peak formation low to the peak formation high. This is the range we are trading in. And well, you ask me, well, why is this important? Well, it's important because when we use a tool like the Fibonacci over here, and we have identified the range that we are trading in, and let's say this is a 4-hour or a daily, it doesn't matter. As I said, we are trying to identify where the market is ranging from. So if I mark up the range over here, we can see that in the middle we have equilibrium over here. And this is a question I get asked many times. Well, why can't I sell below equilibrium inside of this range, whether it be any time frame? It doesn't matter. We have the high and we have the low of that range or time frame that we are looking at. So essentially what we want to do is we always want to sell over here, obviously above, say at equilibrium, or above at further deeper discounts, obviously 61% to 79% idealistically. And that's not always the case. Possibly it bounces off 62% or 70.5% or 70.9%. It doesn't matter. Obviously, we want to sell above equilibrium over here inside of this range. We want to sell above equilibrium, ideally in our sweet spot, but that's not always the case as long as we are selling above equilibrium. And obviously, if we are buying, well, then we want to buy at equilibrium below. And in the same case, that is also 62% to 79% as a deeper level of retracement. So if we look at this range over here, we've pulled our fibs from the peak high to the peak low, or the swing high to the swing low. And if the same we want to buy in this same range and price is moving, we want to look for a good buying opportunity. So if price now continues, anywhere below equilibrium is still considered discount over here inside of the range that we are trading in, the swing high to the swing low. So we are waiting to buy anywhere below equilibrium. And once price moves above equilibrium, you can go and study price action, but generally speaking, there's reaction around equilibrium. And once price has breached that equilibrium point, you do not want to look for buys anymore because it has breached the 50%, because now you are moving into a premium array over here. So the idea is that you want to sell in a premium array and buy in a discount array. So price has breached equilibrium. So you need to wait for price to travel down back past equilibrium into our sweet spot zone over here. And this is where you would look to buy over here and then take price higher over here. And the same would be said if we were looking to sell inside here. Well, then we're waiting to either get a 79% OTE, 62%, but at least we are selling above equilibrium. So that rule applies throughout. We sell at equilibrium or above. We buy at equilibrium or below. Always remember this every time you're wanting to pull the trigger on a trade. Even if you have a limit set, the same rule applies. Is it above or below equilibrium? Look at the chart you're going to trade. Okay, so based on that, what I've shown you here, I need to move on to the next piece. And what I'm depicting here on this chart is something that is going to work and build upon that what I've taught already, which is when we have a Monday. So let's look for a Monday over here on September. So this day over here would have been the 1st. So here would have been the 1st of September around over here. And this is something I have previously taught, that this would have also been the weekly open over here. So if you haven't watched that video, go and watch that video where I discuss the weekly opening price, making the high of the week and the low of the week with the depiction of using the opening weekly price. So these day-to-day opening prices, which is depicted here and I've already drawn up on the chart. This is not weekly, but daily opening price over here. So each of these orange little lines depict the opening price of that particular day. So this being Monday, price then opens and travels away from the opening price. So price travels higher and then comes back down to the opening price and travels lower. Again, the next day starts, price travels up. And obviously you can see what's happening here. We are basically making daily candles. So don't forget the importance of opening price. And obviously this feeds in and flows into how the London market open or the London kill zone creates price action. Generally the high of the day or the low of the day. Notice I'm not saying the week low of the day or the week low of the week or low of, sorry, my head is still a bit foggy from being sick, but I'm depicting here that the daily open comes from the London kill zone, either goes higher in a bearish market and then sells off over here. Creates the daily open, goes a little bit higher, comes, trades lower, goes back to the open. You can see that in a bearish example over here, price spends very little time above the daily open over here. Well, you ask me, why is this important? Well, it's important because this is the opening price of the trading day for the next day. And the kill zone is there to allow the retail traders to be trapped. The market makers are trapping the retail traders into thinking for the opening price of the day, price is going higher, but then instead goes lower. then it trades back to the open, briefly goes when the open happens, price trades higher, briefly staying above the opening price of the day and trades lower. Again, over here, we can see that the London Open is pushing price higher and then taking it lower. See how the opening price is playing a very important role of keeping price lower, and as the trend is going lower, the daily opening price is staying below the traded price and it keeps going lower. And if we move to the right over here, once the market turns, now obviously we are having to adopt the ideas and the concepts taught to us in the form of order blocks or fair value gaps or pulling your fibs. All of that comes into play. So everything I'll ever show you, as I always say, you use it in conjunction with what I'm showing you here. So the opening price as well as the weekly opening price has an important role to play day to day. So again, over here we see price makes a brief high above the opening price, goes lower, trades through it, comes back down, creates the opening price for the day, rallies abruptly away, comes back down to create the next day's opening price over here. And as price is doing this, it is making obviously the high of the day and the low of the day. And where is it originating from? All from the London kill zone. The London kill zone is generally responsible with about 80 to 90% of the time, either the high of the day or the low of the day. That is where price is thrusted from, is the London kill zone. So over here, this is the Asian range. Price comes up 10 a.m. my time. As you can see, this is where this large price action occurs, 10 a.m., which is the London Open for my time zone. So your time zone, your charts will be different based on your MetaTrader time and your broker, but 10 a.m. my time and your time zone might be different. So you'll have to go and check what time is for you for London Open. So all of the highest moves come from the London Open over here. And the daily open, basically as price is bullish, it's going to spend very little time below that daily open. And when it does, and we know the higher time frame directional bias, which we should all know how to do. If we don't, well, then we need to go and watch the previous recordings on Zoom and the videos I've made on YouTube to understand the higher time frame directional bias being bullish or bearish based on the order flow. So as we see here, price spends very little time below the opening price before traveling away from it. And when the trend changes over here, price spends very little time again below the open over here, and price trades abruptly away, coming past the open. And again, the next day, opening price spending very little time below the market open over here. 10 a.m. over here, here's the kill zone. Price manipulates to the upside and then goes back down over here. And you can do simple, small little strategies and tactics over here like this, where you would see that this was the high of the day and this was the brief point in time where price traveled to the lowest point of the next day's open, below the candle open over here, and into a premium area for us to sell at over here, and then price fell down. And this is how the London market and the daily opening price can help us to determine the trades based on every other concept I am teaching as well. And in obviously once price direction changes and the order flow becomes bearish, you can see price spending very little time below or above, in this example above, because it's bearish, very little time above the opening price before trading lower over here. The next day over here, we have price coming in, making a high of the day over here, coming to the open, spending little time over here. Here is the kill zone for London. They manipulate to the downside. And over here, if you see that we have a range to work in over here. So a range from a swing high over there. And here we have a swing low over here. So if we were to pull our fibs from a swing high to a swing low over here, we get an area of premium. Now notice that swing high and that swing low comes to a point of equilibrium over here. Price is trading above over here, making the swing low. Price trades above equilibrium, and we are looking to sell above equilibrium over here. That's the swing high, that's the swing low. Here is equilibrium. Now I know that I have taught you to use the bodies over here, but the same result occurs. Obviously, I'm just showing you swing high, swing low, peak formation low, peak formation high, and coming into a premium array, noticing where equilibrium is, because we are selling above equilibrium or buying below equilibrium over here. So just like we could have sold above equilibrium, we have that swing high over here and that swing low. So anywhere above this equilibrium, sorry, below this equilibrium, anywhere below here, once we have this swing low, swing high, and this swing low, this is still discount because it is below equilibrium, based on this being the peak formation high and this the peak formation low. So here is equilibrium, and anywhere below here is still considered discount to buy over here, and then it takes price higher. Okay, so next, I want us to draw attention here to GBP USD and this large move over here to the downside. So from this low, from this high to this low is about 665 pips, give or take. And I'm going to mark up that this being an order block over here, it is the last down candle before this move to the upside, which breaks and takes out this liquidity over here. So I'm going to mark up this as an order block. So that green line over here is the top of that order block, and this green line here is the bottom of that order block. So what I've just explained about trading inside of the range, we are now going to go and look at price action. We are wanting to buy at this bullish order block because it is responsible for a substantial move to the upside and taking out these highs over here. So when price comes back into this order block over here, as we see, I will now go down to a lower time frame on this candle of 15 minutes over here, and we can see that when price gets to this order block, here is the top of that order block over here, this green line is the top of that order block, and when it touches that order block, we see here on the 15-minute chart, yes, we have this swing high over here, and yes, we have this swing low over here. But now we are on a 15-minute chart, so the swing highs and the swing lows are different because we are on a lower time frame. So the most recent swing high where price is currently trading at, here is our most recent swing high, and this we are saying is the most recent swing low based on the current price action that is occurring right now. So again, before you pull the trigger on a trade based on maybe an order block or a fair value gap being filled, maybe there was a liquidity run, whatever other confluences you are building up, go down to the lower time frame to see reaction. This is a question I get very often. Well, how do I know when to enter the trade? Well, here I'm giving you that. This is the swing high created inside of the range we are currently trading in based on the 4-hour order block we are wanting to buy from. So here we have the swing high, the swing low, and you can see that this is equilibrium over here. So we are wanting to buy below equilibrium, hopefully at OTE 79 or 62, but anywhere below equilibrium is fair game to buy. So if we see now, we missed our opportunity to buy over here because price is now trading above equilibrium over there. So now we wait for price to come back down. Again, it's still above equilibrium over there. We are waiting for price to come back. We are still trading inside of our range over here. Here's our swing high. Here's our swing low over here. Okay. And if I just pull my fibs across over here, here is OTE. Again, if we were patient, if we did not wait for our entry and decided, oh, we see price already bouncing and moving away from our order block like we do over here, and we bought below the range where we should have, like here, we should be waiting to buy below equilibrium, and price comes back. It gives us a second opportunity. Don't be hasty. Just because you see price bouncing and moving away does not mean it won't give you a second opportunity over here. So this range that we are trading in over here gave us a second opportunity to get into the trade over here. Here is OTE, and we could have bought at OTE. If we did not buy over here, we are waiting because it has moved away and it's higher than equilibrium. So we're buying at a premium. We don't want to buy at a premium. We want to buy and discount anywhere below equilibrium, preferably in our sweet spot. Okay. So here we waited and we got the opportunity to buy at OTE, and we got 60 pips or 50 pips or whatever our target was for that range over there. So now once we have traded through our range over here, we want to look for a possible second opportunity on our order block that gives us that range. So we want price to move away from our range over here. So I'm going to delete this because we're now going to move into a new range over here. And here we have a new swing low. This is now our new swing low over here. This is our new swing low. And we are waiting for price to make a new swing high over here. Here is the swing high that it made. So if we know that this is the swing low and that's the swing high, we could look to buy below equilibrium. If we are buying above equilibrium, we are buying at a premium price, which means that at any time, price could fall. If we have the high time frame directional bias that it is bullish and we are buying above equilibrium, we are buying at an expensive price. You do not want to buy at current market price if it is above the equilibrium of the range we are currently trading in over here. Okay, so as price moves, we have the range we have pulled, and just so that everyone knows, I still do body to body. I'm just showing you the range we are currently trading in. So body to body, still giving you very similar result. Very few times it will tell you otherwise. Okay, so essentially we are looking to buy at any time. We do not want to buy above equilibrium. So even over here, 62%, 62%, 62%, multiple times for an entry to the upside. So we are always trading inside the range. Look, when you open your chart, where are the order blocks? Where's the fair value gaps? Use your fib tool. It's a tool to tell you where price is expensive, where price is discount. And this is how you will frame up your entry and avoid going into unnecessary drawdown. That is a question I get very often. Well, how do I know when to enter? This is how you enter your trade over here. So when you have a low created and price moves away from that low, here we have a swing high over here, as well as here we have a swing high. For this range, we are trading it over here. So there's nothing stopping you from entering scalps all day, every day. Here is a swing high, here is a swing low. If you want to trade inside of this range, you want to sell at a discount or sell at a premium and buy at a discount. So you're selling above equilibrium, possibly our sweet spot. In reverse, we are trading inside of this range. So if we're wanting to buy, we're wanting to buy at a discount. Here is our range we are trading in. Here is discount. Here is premium. Here is equilibrium. So make sure that you are aware of the range you are trading in, the high to the low, and where is equilibrium based on if you want to buy or if you want to sell. And also do not forget the opening price of the day, as well as what I've taught in conjunction with the weekly opening price, because this will help you to determine how price action works day to day as well as week to week. Okay, so those are the three things I needed to show you. And if anyone has any questions, please go ahead.
Hi, Darren. Hello.
1 second.
Hi, Darren. Can you hear me?
Yes, I can. Go ahead.
Last step broken LSB. Does price have to close under the low of that candle before you consider a retrace?
Correct. Every time and all the time there is an LSB, price must close above it. So, okay, let's look at this right here. I can see an LSB over here. So I also notice that I'm using the candle body. So here's the candle body, the highest candle body, not the wick. You see that? So I don't know if you've been using the wick, but this is the wick of that peak formation high. This is the body of that peak formation high. This is the highest body. Do we see that? Closing price, highest body. So I use the closing price, the highest closing price, or the lowest in reverse. So here we have LSB. Last down candle was traded through, and this is the candle that closed below that order block, or last step broken, LSB. And here we have that retest. Now, LSB is just an entry tactic. It is not to say that every time this will give you an entry, but generally speaking, you will get some good entries using LSB. It should not be your only entry tactic, because the same will occur over here. If we do a fibs, you'll see you get OTE as well as it being LSB over here. So let's see over here. We have a low formed over here, which would be in reverse. Last up candle before these candle bodies were the lowest over there. This is the LSB, and this is the retest of that LSB. However, if you do the same over here, body to body, OTE. So it works very similar to using your fibs, where you can have LSB entry as well as fib entry. Sometimes they align with each other to give you a double confirmation to sell or to buy on a 15-minute time frame. Does that answer your question?
Oh, yes, it does. I think I didn't understand what LSB was. I didn't know about marking the close and the open, not the wicks.
So sometimes the reason why I use bodies is because sometimes wicks can be very long and it is not closing price over here. So I only use closing price. I only care about closing price. I do not follow wicks. Wicks are noise to me. So that is why I do not consider wicks when I pull my fibs to look for an entry. I use wicks like I just showed you now to determine a price range of where price can range inside of. I do not use it if I want to pull a fibs. I only use bodies to pull my fibs. And the same for LSB. I only use the bodies of the highest candle in that peak formation high or peak formation low over here. Anyone else got any questions? Or maybe you have another question?
You can check your chat on Telegram, please.
What day was that that you sent me Euro USD?
Or on Friday this week.
This one over here.
Yes.
Okay, so again, sometimes you just don't get LSB. Here's your LSB, right? And there was no price close below it before a retracement. I don't see any. So here's that LSB, and price only closed below that LSB over here on this candle over here. And then there was no retracement over here. So we are wanting retracement into this LSB to look for a selling opportunity, and we did not get that over here. Same with this peak formation high over here. We did not get LSB entry over here. Even this wick over here did not touch that LSB if we marked up this as our LSB here. So here would have been our other LSB over here if we had used this one for closing price below over here. And this is actually the peak formation high on the 15-minute chart because the bodies are higher over here, or probably about equal highs. But whether you use this one or this one, you had no entry because there was no retest unless you use this candle over here, which almost tested it, but not exactly. And let's look for other examples. So here we have an example of one. If you wanted to sell over here, we could have got LSB retest over here, as well as body to body, OTE, 79%, 62%, sweet spots, LSB retest. So two confirmations to sell over there. So LSB and fibs can be your friend on the 15-minute time frame, as well as knowing the range we are currently trading in. So here's that range: swing high, swing low, fibs. In that range, we are wanting to sell above equilibrium or buy at or below equilibrium here. And we could have sold inside here. Once we have this range, would have been in this price action over here rather. But the same applies. Someone wants to raise their hand? Who raised their hand now? Anyone else got any questions? Okay, well, no one else got any questions, so I'm assuming you all.
Can I ask another one?
Yeah, sure, go ahead.
I usually have a hard time choosing the current range, especially when I go down to lower time frames. Should I just basically stick to the immediate range and not focus on the bigger ranges?
Okay, this is going to take some training, but obviously the range you are trading in with the time frame you are looking at is important. So just like you have marked up a higher time frame order block or fair value gap, or you've pulled your fibs on a higher time frame, you are now looking for entry in the time frame you are looking at. So if price is coming into, let's say, a 4-hour order block or a 4-hour fair value gap, then yes, you can use the 15-minute range you are trading at once you have gotten reaction from the order block you have marked up on the higher time frame, and that could have been a daily order block or a 4-hour order block or even a 1-hour order block. When you come down to a lower time frame, you are essentially looking to take an entry. Alternatively, you are scalping on the 15-minute time frame. If you are using the 15-minute time frame to trade from, either you are looking for entry or scalping. You need to know what's happening on the higher time frames to be able to see where price can potentially go, so you can know how many pips you want to catch and where your profit targets need to be. But generally speaking, profit targets should be above or below, at equal highs, at equal lows, and points of liquidity. Yes, Martin, LSB is explained in the previous video library, as well as the weekly open. This daily open and trading inside the range is just to touch and build upon that previous knowledge. So this was a brief session, but to the point. I hope you all enjoyed it, and I will take some more questions next week. There won't be any new content I will deliver to you guys.